Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market Analysis, June 4, 2026. This video presents a direct informational narration of the source document. Today's analysis follows a strict chronological traversal across 6 key areas. We're looking at market rotation and tech, semiconductor earnings and valuations, macro, geopolitics and bonds, market breadth and volatility, the crypto sector liquidity shift, and finally, specific equity movers. Section 1. Market rotation and tech. On June 4th, we saw funds actively rotating into cyclical and defensive sectors. This actually offset the pullback we saw in semiconductors, resulting in the Dow closing up 1.73%, the Nasdaq slipping just a tiny bit by 0.09%, and the S&P 500 closing up 0.41%. Moving right along to Section 2, Semiconductor Earnings and Valuations, we are seeing a real repricing of market optimism here. Diving into the semiconductor space, Broadcom stock took a pretty sharp hit, dropping over 12%, as extreme market crowding really started to show some fundamental cracks. The numbers paint a clear picture. Their Q3 AI semiconductor revenue guidance came in at $16 billion, which missed the $17 billion expectation. And if you look at their full-year AI chip sales, they guided for $56 billion, falling short of that $57.6 billion consensus. Adding to that pressure, management openly acknowledged that their top customer, Google, is actively diversifying its supply chain. This is a massive deal because it means they could potentially shift critical market share for things like the Google TPU over to competitors, namely MediaTek and Marvell. But it's important to frame this correctly. This Broadcom decline really reflects a repricing of overly optimistic expectations and a valuation compression, rather than any kind of fundamental weakness in AI itself. Technically speaking, the stock just pulled back to its 10-day moving average, which is acting as midterm support, and it's showing potential for consolidation above its 50-day moving average. We saw a very similar story play out with CN. Even though they reported $1.57 billion in Q2 revenue, that's up 40% year over year and a massive 290% increase in EPS, the stock action was absolutely brutal. It plunged more than 20% intraday, breaking its 50-day moving average for the first time since July. It just goes to show how a valuation bubble can burst after a stock appreciates 6 to 7 times over a 12-month period. Across the rest of the space, the daily performance was definitely mixed. NVIDIA actually rallied to support the broader market. On the flip side, Micron dropped over 7%, pushing its KD indicator below the 5-day moving average, and that's despite having really strong supply-demand fundamentals. As for the broader semiconductor SOX index, it took a huge dive, dropping over 6% intraday before recovering late in the day to close down just 2.15%. Despite all this volatility, the big tech giants like Meta and Microsoft are maintaining their AI capital expenditures. They're highly unlikely to cut spending before the end of the year. Why? Because they have deeply integrated financial interests tied to upcoming IPOs from entities like OpenAI, keeping them locked into current spending levels. All right, Section 3, Macro, Geopolitics, and Bonds, Yields and Middle East Tensions. Shifting gears to macroeconomics, the 10-year Treasury yield fluctuated right around 4.5% as geopolitical dynamics rapidly evolved in the Middle East. Looking at the timeline, on June 3rd, Iran targeted a U.S. base and a Kurdish airport. The very next day, Hezbollah rejected a U.S.-brokered ceasefire. Following these attacks, Trump maintained a maximum pressure strategy, signaling patience without rushing into a wider war unless U.S. troops are actually harmed. Interestingly, WTI crude oil actually fell. Congress voted to limit war powers, which reduced the geopolitical war premium. At the exact same time, JP Morgan Research put out a highly optimistic projection, stating that global inventory drawdowns will force the Strait of Hormuz to reopen, noting this could possibly happen within June. Next up is Section 4, Market Breadth and Volatility, Technical Support Levels. Observing the technical indicators, we saw some incredible resilience across major indices. The S&P 500 initially gapped down, but it rallied right back to the 7,600 magnet level. This was heavily supported by options market maker hedging, a dynamic that will remain effective all the way up until the June 18th expiration. We saw similar support elsewhere. The Nasdaq found algorithmic buy support right at its 20-day moving average. Small caps, tracked by the IWM, fully recovered their losses from yesterday, which is a fantastic indicator of healthy sector rotation. And the VIX, it remains lazy, moving in that historically low 15 to 16 range, basically just awaiting mid-June Fed catalysts.
Section 5 is a fascinating one. The crypto sector liquidity shift. AI drains high-risk capital.
In the cryptocurrency space, Bitcoin experienced a drop down to $61,000, and this significantly altered predictive market odds. According to Polymarket data, there's now an 84% probability of Bitcoin dropping below $60,000 this year. There's a 59% chance of it breaking $55,000 and only a 23% chance of it returning to previous highs. To put that into perspective, that probability was sitting at 50% just back in May.
So where's the liquidity going? MicroStrategy's CEO noted that AI is literally draining high-risk liquidity. Over the last 6 months, a staggering $400 billion flowed into AI infrastructure. Compare that to Bitcoin ETFs, which saw $4 billion in outflows since May 14th. This is being broadly characterized as a massive cyclical rotation.
And finally, Section 6, specific equity movers across healthcare, IPOs, and retail. Examining specific equities, we saw significant technical movements and fundamental shifts as capital rotated. In healthcare, LLI surged 6.8% to aggressively test its 200-week moving average resistance. UNH also had a great day, rising 5.16%. And we saw retail giant Walmart gain 2.5% intraday, acting as a defensive hedge during the broader tech sector fluctuations. Looking at ARM, the stock has surged an incredible 260% year-to-date. The market is essentially pricing in its prospects all the way out to 2030, making it one of the most expensive stocks out there, just behind Tesla and PLTR. But it couldn't completely escape gravity, closing down 4.47% after taking an intraday 10% drop alongside Broadcom. Then there's CrowdStrike. It managed to recover from a 10% drop to close down just 3.8%. This price action coincided with some powerful commentary from its CEO, who stated that new ChatGPT and OpenAI models are dramatically accelerating both cyber attacks and our defensive needs. He marked this as a clear industry inflection point. Wrapping up the specific movers, financial stock SoFi managed to stabilize right around its 50-day moving average. The quantum computing IPO IonQ closed slightly up by 0.63%. But it was a totally different story for Lululemon, which plunged after hours. That drop was triggered by lowered corporate guidance and their specific vulnerabilities to potential tariff policies. Looking ahead, the market is anxiously awaiting Friday's non-farm payrolls report. It's largely expected to align with consensus estimates without any major surprises. But you have to ask yourself, in a market rotating this aggressively, what happens if the data doesn't just confirm what we know, but introduces a massive new macro catalyst? Are we prepared for how that could suddenly shift the landscape?